Hello traders, Gary Wagner here. It is 12 noon in Honolulu, 5 o'clock in New York on Friday. Happy Aloha Friday as we say on the islands, 10th day of February 2023, and this is the Weekend Review. The price of gold and silver, as well as U.S. Treasuries and to a large extent stocks, have been based upon the words of various Federal Reserve members and adjustments in their monetary policy. The news really of last week's potential new target, taking rates as high as 6% as opposed to 5%, started a correction after Thursday's high was reached at almost $1,980 per ounce. We're currently trading at $1,876 and change after factoring in a decline today of $2.10. Silver also traded lower today, giving up approximately 13 cents, with the most active March silver futures contract a half a cent above $22. Both gold and silver faced moderate to strong headwinds from dollar strength today. The dollar gained approximately 0.35%, and the index is fixed at 103.47. Compared to last week, this week's price range is tepid and muted at best because the big move came on Thursday and Friday, resulting in a combined two-day loss of about $90 per ounce. The first three trading days were interesting in that they contained consecutive higher highs and higher lows, but when you look at the body size, and we've talked about this all week, there wasn't a compelling case to be made that we were looking at a potential bottom in the market and an end to the correction. Although it went to the 38.2% retracement level, which is a respectable but shallow level, we acknowledge that at least currently traders are focusing on headlines, statements by various Federal Reserve members, and has less to do with a technical study and more to do with the narrative of the Federal Reserve. Also, we saw prices adjust to the fact that the Federal Reserve most likely has changed their target in terms of rate hikes to closer to 6% than December's projection of just above 5%. And that is why I believe we've seen pressure on the market, which resulted in the highest value this year on Thursday, but also the beginning of a sharp sell-off. We broke below the 38.2% retracement today on an open and closing basis, but as I said, I'm really looking at this as being event-driven. However, we can use this tool to project at least price points that we could see should it continue to decline next week. The first level is a 50% retracement. In other words, we're looking at this leg of the rally here, and the halfway point comes in at $1,846. A deep correction would be the 61.8% level, and that comes in just above $1,816. But where we see prices end up at the conclusion of this correction will be driven upon the current narrative of the Federal Reserve, as well as the data that comes out, such as Tuesday's headline CPI report on inflation. This next chart is also a daily candlestick chart of gold. However, it has a much larger focus. Our focus has been specifically on this leg of the rally, starting at around $1,719 up to the highest value this year, just shy of $1,980. This chart gives us a good perspective in terms of the recent top because it does match a price point that we have identified as potential resistance, which came in a few dollars below the actual high that we saw last week, and it is based on a interim top that wasn't as important as a major top, that is this area right here, but that's not what we considered to be one of these major price points that were the series of lower highs and lower lows. The last chart that we will look at on today's technical studies is a daily gold chart, but we've converted it from standard Japanese candlesticks to a Fibonacci. The key difference between a candlestick chart and a Fibonacci chart is how the open is fixed. They fix the open off the midpoint of the prior trading session. So on a daily chart, it would be the midpoint of the prior day. And what it does is it really removes some of the noise in the market. And what you see is that during periods of rallies, you get almost all consecutive green candles. The larger the body size, of course, and the absence of the lower wicks is an indication of strength. Then when you look at the corrections, all red, you had a little bit of alternating color, and that's telling you that the trend itself could go either way, and it's consolidating. Typically what you're seeing is a new high and then a period of consolidation, and all things being equal, then a return to rally mode in a bullish market scenario. In this case, that's exactly what occurred, but you can see that towards the end of the rally, prior to the big drop, we had the appearance of lower and upper wicks on these green candles. They also had smaller body size. We had a couple of red candles with small body size. This is an indication that the bullish trend that defined recent price action was waning. Absolutely. We then had a sell-off, and again, all red candles all the way down, but these most recent candles have upper and lower wicks as well as smaller body size. Lastly, as you can see, we've added a Fibonacci extension. What we're looking at is the relationship between the first leg of this rally, beginning on November the 3rd, and then after the correction, we then want to see what is the relationship between the price move here and the third wave, which is typically the largest wave and can never be the shortest of the three impulse waves in that impulse cycle. The textbook model for a third wave, when we compare it to the first wave, is an extension of 1.618, and that would have taken gold much higher than the actual top, but the top does match quite eloquently to the 1.5 extension, so it fits within very acceptable parameters, and it did take gold to the highest value this year. This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Have a great weekend. Bye-bye.